Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to get to it today with the economy, as we usually do, and there's a notable pattern that's developed among analyst forecasts, so we want to talk about that. There are some consequential data points, although nothing like the pace that we had in the last 2-week period, the last time we did this. We're going to talk about the relentless move higher in equities, and we'll talk about the relatively flat interest rate environment, along with the Federal Reserve, its changes in projections from the recent meeting to the last, and discuss what the implications are for our asset prices. So getting right into it, we start with sentiment and manufacturing information, all of which is expected to show either inline or strengthening numbers here. And what does that tell us? That tells us that the analysts are thinking that economic conditions are actually starting to become on the upswing. Factory orders expected to show a market climb, durable goods remaining in line. That says that we're expecting demand to firm a little bit and remain strong and stable in at least the durable goods. Going into the Purchasing Managers Index and the services, that's expected to show flat to upward motion. And, we were talking about a trade balance that's narrowing. We're talking about a labor market that's remaining relatively in line and stable. They are expecting the payrolls number to come in a little bit lighter. But that's actually a sustainable level where, we could ease back concerns that the economy is overheating while it's still remaining relatively robust. So if the number comes in here, this is one of the big market moving numbers that's going to come in, and it's Friday. If this number comes in too hot, we're going to be looking at potential for the market to be pricing in higher inflation. So we need to watch that. Unemployment expected to show a little bit of a decline. And then the consumer price index, that's supposed to show a little bit of a deceleration. So it seems that market expectations are for showing decelerating inflation. We're not so sure about that. The other signals don't suggest that we're going to see decelerating inflation. And certainly we've not seen any evidence that that's going to be the case in our own analysis. However, maybe it does do that. And if it does, that's actually good. That means the Fed is in a position where they can kind of hold status quo instead of lowering or raising rates and let the economy continue to grow. So that would be a very good situation, particularly in the stock market. Looking at producer price index, that's expected to show pretty marked deceleration as well. And then we get more labor market and more sentiment information. So that'll round out the economic data on tap over the next couple of weeks. Let's talk about the equity market, which continues a relentless climb. It's a bull market. Bad news doesn't do anything. Good news causes it to go up. Even bad news sometimes causes it to go up. So that's heralding a bull, expansion in equity prices, and we're going to keep expecting that to continue until it doesn't, until things change. There's got to be a catalyst for something before we're going to start calling for a top, even though a lot of the analysts are saying, oh, the market's looking toppy, people on CNBC, etc. We don't see any evidence of that yet, and we want to wait until the market tells us that, not some television personality. So moving into one of the items that's been talked about rather vociferously is the fact that, this is all generated by market leadership, the Magnificent Seven, et cetera, et cetera. And we want to examine that hypothesis. So I pulled up the S&P Equal Weighted Index for us to take a peek at. And this is notable. It's a very similar pattern. It's trading up to new highs, and that's an index where every member of the S&P is basically an equal weight in the index, as opposed to cap weighted, where the Magnificent Seven have outsized sway. The fact that these two indexes are doing the same thing together tells us that the broad market itself in equities is very robust. So this idea that the Magnificent Seven and the market leadership is all that's moving higher is obviously not in line with what reality is as measured by this index. So we're going to pay attention to the facts, the data as it comes, and not what the opinions being expressed on TV are, and say that this is a sign of overall market health in the bull market that's going on in the headline S&P number. So what's going on with volatility? Well, we're at pretty low levels generationally speaking, and that's good, but it also could be bad, because notice many of the spikes that have happened, crises, come from very low levels of volatility where the expectation is for nothing weird to happen, and then all of a sudden something happens. So maybe the Fed all of a sudden decides that inflation numbers are coming out too hot and they need to hike rates when everybody's expecting 2 cuts. Something like that could cause a rise in volatility, and we're going to be mindful of that and continue to keep our eye on the equity market. But until we see some sort of thing like that, or some numbers starting to come in aggressively too hot that telegraphs that, we're not going to be doing anything. We're going to let the market continue to do what it does. In terms of rates, they remain flat. This is the government yield curve, which shows that, yes, there is an inversion, but more importantly, the inversion telegraphs recession, and it's starting to move into a less steep of a slope. In other words, crisis may be abating and pressure's easing out of the system. However, the longer-term area of the curve is still well above 4%, and that suggests that we have a longer-term inflation expectation among the most sophisticated and large asset managers in the world and market participants in the world that says, hey, inflation's going to be higher, 3.5%, maybe even 4%. So we, over the long term. So we've got to continue to watch that, and this is what we're going to take our cues from, rather than whatever the telegraphed, commentary is from the media. So looking at the A-rated curve, that's pretty much the same as well. Rates are pretty high. 5-year paper is 4.8. 10-year paper is 5%. That's relatively flat-ish on the curve as well. And, it suggests that the income investors are getting paid well, whether they're using those income investments to hedge stock exposures in a 60-40 or risk parity portfolio, or they're using interest rates to live on as fixed income investors, perhaps in retirement or for some other reason. So as we look at this, investors are getting paid to hold bonds in a way that just hasn't been possible up until the past year. And that's a very profoundly good thing. What is going to happen with rates going forward? Well, we are going to look at the dot plot again, which made its first appearance last time we did this, and we talked about what happened at the last Fed meeting. Now, this one is showing both the last meeting before and the one before it, so that we can compare the two and say what has happened with the Fed's expectations on their survey. Because anytime we're looking at data, we want to be asking our question, compared to what, in order to get an idea of what's really happening. Financial data on its own, without any, comparison, is relatively useless. You have to see what's going on, what's trending, how it's moving, in order to really get a key idea. So whether it's how it's moving relative to other things or how it's moving relative to itself, we have to examine those items, because it's going to give us the information that fleshes out our opinion about what's happening and our market positioning. So looking at this chart, the gray here is the December meeting dot plot, and the yellow is the most recent one. And notably here for 2024, we've had a couple of expectations move up into the median here, but the median remains the same. 4 5/8 is the expected ending of the year rate on the overnight rate. Where things start to get interesting is, for 2025, that median number was 3 3/8, and now the median number is moved up to 3 7/8. So that shows a market climb in terms of interest rate expectations through 2025, and it suggests that the Fed thinks it's not likely to be able to lower rates as aggressively as it wanted to in the face of this, strong economic data, presumably. And then again, even more so, 2026, we moved out from 2 5/8 was the implied rate, and then we're up to 3 1/8. Actually, I take that back. I think the median rate down here was here. And that is 2 7/8, and it's actually moved up to 3 1/8. So, looking at out into the longer term, this doesn't really mean much. In financial modeling, there's a thing we call straight lining, where eventually we get out far enough to where the forecast is muddy. We just pick a number and flatline it out forever to discount it so that we can get a good read on what's going on in the shorter term. And that's what's being done here on this quote-unquote longer term dot plot. So they're straight lining out an idea that, hey, rates are coming down to that 2.5 level, which we don't think is actually tenable or going to happen. Now, going into the S&P index again, while this continues to climb, there has been a notable, tendency for everyone to get excited about this and get on the bandwagon. But we want to point out, and let's go back like we always do, and we'll close this way. We're going to go out and look over 20 years. And it does not pay off to participate in the market manias. So when the market starts going down and down and down, we don't want to panic out. And at the same time, when it's doing nothing but go up, we don't want to start pushing all of our chips on the table and saying, well, we're just going to get as big as we possibly can and go all in on stocks. We don't want to get excited and join this party either, necessarily. We want to adhere to our disciplined investment plan. And in our case, typically those plans involve periodic rebalancing to make sure that the stocks that have gone up in these moves are returned back to a good percentage in the portfolio for exposure to keep risk down, and to take some of that profit off the table and reinvest in some of the other names that haven't been doing as well, so that the positions can continue to move and work for the investor. We take a very disciplined buy and sell approach, and we apply it over years regardless of what's happening in these interim periods, in short-term periods, because it's just not our strategy to make changes to a long-term investment plan based on short-term conditions in the market. If our time horizon is 10 years, our time horizon's 10 years, and we're not worried about what's happening over any one of those years, we're going to continue to adhere to a strategy, and we want you to be doing that. If you have questions about the portfolio, if you have questions about the economy, the market, the Fed, we're going to be delighted to talk about it. That's what we're here for. Hope you found the video useful. Thanks and have a great day.